When clients pay in euros, pounds, Swiss francs, Canadian dollars, or any other non-US currency, the receive side infrastructure is what determines how much of every payment the bank's foreign exchange margin eats before the money lands in your account. This video walks the three approaches for receiving international payments and the criteria for picking the one that fits your volume. The invoicing currency decision, which currency you bill clients in, is module 8.7, and the two have to align for the savings to actually show up. Skip or stay, depending on your client base. All clients pay in US dollars. Skip this video and come back if that ever changes. Any clients pay in euros, pounds, Swiss francs, Canadian dollars, Australian dollars, or anything else non-USD, stay, because the next 6 minutes save you somewhere between 2 and 4% of every international transaction depending on which approach you pick. The rest of the structure from Unit 6.2 through 6.6 works identically either way. This unit is purely about the receive side for non-USD payments. Picture the FX cost concretely. A client in Munich wires you 2,000 euros for a coaching engagement. The wire arrives at your standard US business account, which converts the euros to dollars before depositing. And the conversion rate the bank applies is not the mid-market rate you see on Google or in the news. It's the mid-market rate plus a spread the bank keeps, typically 2 to 4%. On that single payment, the spread costs you 40 to 80 euros that disappear into the bank's margin. Multiply across a year of international invoicing and the FX line item becomes a material expense category worth attention. Three approaches handle international receipt, and the right one depends on volume. A multi-currency business account like Wise Business converts near mid-market plus a small fee, best for regular international volume. A neobank's multi-currency receive varies by provider, best when your existing neobank already supports the feature. A standard bank international wire keeps the full 2 to 4% bank spread on every transaction, best only for one-off international clients where the volume doesn't justify any setup work. 3 rows in a comparison, 3 different break-even points depending on how often non-USD payments arrive. The multi-currency business account is structurally the lowest cost option at any meaningful international volume. You get assigned local account details in the major currencies you receive, a German IBAN for euros, a UK sort code and account number for pounds, a Canadian account for CAD, and so on. Clients send payment as a domestic transfer in their own country, which costs them nothing and arrives in your account in the original currency, not converted. You hold the balance in foreign currency until you decide to convert. And when you convert, the rate is at or near mid-market with a conversion fee usually under 1%. Module 19 has the current feature comparison. Some neobanks have added native multi-currency receive that approximates the WISE model, and capability varies provider by provider. Before opening a separate account anywhere, check whether your existing neobank already supports the feature for the currencies your clients pay in. An integration that lives inside your existing banking relationship beats a separate account at a separate provider when the features are comparable. Every additional account is another login, another set of statements to download for the bookkeeper, another reconciliation surface. Match capability first, then optimize for fewer accounts when capabilities are equivalent. Bookkeeping integration is the piece coaches forget until the first foreign currency transaction lands, at which point the cleanup is more painful than the setup would have been. Multi-currency banking adds one reconciliation step that USD-only banking doesn't have, the exchange rate gain or loss recorded when foreign currency is converted to USD. Your bookkeeping software almost certainly handles multi-currency natively. QuickBooks, Xero, both do. But you have to enable the feature, configure the foreign currencies you receive, and set up the accounts for exchange rate gain and loss. Brief your bookkeeper before opening the multi-currency account, so the chart of accounts is ready before transaction 1. Module 8.7 is where the invoicing currency decision lives, and the two modules have to be set up coherently for the savings to actually materialize. If you invoice your German client in US dollars, their bank does the conversion before sending, and you receive USD straight to a regular account. No multi-currency infrastructure changes anything. If you invoice them in euros, you receive euros and you do the conversion. That's where the multi-currency account saves you the spread. Coherence between the two sides is what produces the savings. Invoice in client currency upstream. Receive through a multi-currency account downstream. Conversion happens once at near mid-market, rather than twice at full spread. Open the multi-currency decision sheet if international clients are part of your practice now, or are about to be. First, check whether your existing bank or neobank already supports multi-currency receive for the currencies you need. If yes, evaluate the rates and fees there before opening anything new. If no, compare the two principal alternatives: Wise Business as the dedicated option and any neobank that adds the feature on the criteria in the sheet. Open the option that fits before your next international invoice goes out, not after. Last unit ahead. If you've been mixing business and personal accounts up to this point in your practice, Unit 6.8 is the cleanup protocol. The universal entry logic for unmixing after the fact, the threshold for when self-directed cleanup is workable versus when you should engage a bookkeeper, and the brief you'll give that bookkeeper to keep the engagement bounded rather than open-ended.